Most Canadians hear the same advice every year. Max out your RRSP contributions. It's the smartest thing you can do for your future. And while RRSPs are a powerful financial tool, there are situations where contributing to your RRSP might actually hurt your financial future plan more than it helps. In this video, I'm going to share 5 reasons why you might want to hit pause on contributing to your RRSP. Some of these reasons might surprise you, and others might even have you rethinking your entire savings strategy. Let's dive in. Reason number 1, you have no or low taxable income. If you're earning little to no taxable income this year, say below the personal exemption threshold of $15,705, contributing to your RRSP likely isn't the best move. Why? Because the primary benefit of an RRSP is the tax deduction you receive, which reduces your taxable income. But if your taxable income is already so low that you're not paying much or any tax, that deduction doesn't give you much value. Instead of locking that money up in an RRSP, consider other options like contributing to a tax-free savings account or TFSA, where you won't pay tax on the growth or any withdrawals. And remember, unused RRSP contribution room carries forward indefinitely. So you can save your room for a year when you're in a higher tax bracket, making your contribution far more beneficial. Reason number 2, you're incorporated. If you run your own business and have a corporation, RRSP contributions may not be the most efficient way to save. Here's why. As a business owner, you can already lower your taxable income by leaving money inside your corporation rather than paying it out to yourself as a salary. Instead of using an RRSP, you could save within your corporation and invest that money directly. This strategy allows you to defer personal taxes for as long as possible while still growing your wealth. Plus, if you ever decide to pay yourself through dividends rather than salary, RRSP contributions won't even be an option since dividends aren't considered earned income. If you're incorporated, talk to a tax professional to explore other tax-efficient strategies for saving and investing. It could save you thousands. Reason number 3, you already have a substantial RRSP. Bigger isn't always better when it comes to the RRSPs. If you've been diligent about saving over the years and already have a large RRSP balance, contributing more could create tax issues down the road. Here's the problem. When you retire and start withdrawing from your RRSPs, those withdrawals are treated as taxable income. If your RRSP is too large, your required withdrawals could push you into a higher tax bracket during retirement. You might also lose access to income-tested benefits like old age security or OAS because your taxable income is too high. What can you do instead? Consider putting savings into a TFSA or even a non-registered or open account to diversify your retirement income. This way, you'll have more control over your taxable income in retirement. Reason number 4, you already have substantial pension contributions. If you're contributing to a workplace pension, that could significantly impact how much you should contribute to your RRSP. Pension contributions reduce your RRSP contribution room through what's called the pension adjustment. And adding personal contributions on top of your pension savings could create unnecessary tax inefficiencies. For example, if your employer is already contributing to your pension plan, you might want to prioritize saving in a TFSA or non-registered account instead. These options provide flexibility, tax-free growth, and no taxable income when you withdraw funds. Remember, retirement planning isn't just about maximizing one account. It's about creating a balanced, tax-efficient strategy. Reason number 5, you're planning to buy your first home. If you're saving for your first home, you might think the first-time homebuyers plan makes RRSP contributions a no-brainer. After all, it lets you borrow up to $60,000 from your RRSP to use as a down payment. But before you rush into this, consider another option, the First Home Savings Account, or FHSA. The FHSA combines the benefits of a TFSA and an RRSP. You get a tax deduction for your contributions, and any withdrawals for a home purchase are completely tax-free. The big difference? You don't have to pay back the money you withdraw, unlike the first-time homebuyers plan, which requires you to repay the borrowed amount within 15 years or face significant tax penalties. If you're saving for a first home, maximize your FHSA contributions before turning to your RRSP. It's a more flexible, less risky way to reach your homeowner goals. RRSPs are a fantastic tool for many Canadians, but they're not always the best choice for every situation. If any of these scenarios apply to you, think twice before contributing to your RRSP this year. 1. You have little to no taxable income. 2. You are incorporated and can save within your business. 3. You already have a substantial RRSP and want to avoid higher taxes in retirement. 4. You're contributing to a workplace pension plan and want to diversify your savings. 5. You're saving for your first home and want to take advantage of the FHSA instead. The key to financial success is understanding which tools work best for your unique circumstances. If you're unsure about the right strategy for your goals, don't hesitate to seek professional advice. If you found this video helpful, don't forget to like and subscribe to my channel for more practical tips on saving, investing, and retirement planning. And if you want a customized strategy to make the most of your savings, click the link in the description to book a complimentary consultation with me.